Hi everyone, welcome to our market talk. So another 2 weeks have passed. Interesting. Last time we were talking about possible breakouts and whether this move has some legs or not. As we can see, everything is continuing to grind higher. And yeah, I'm sure we have a lot to talk about. Rollover has started, so soon we will get new numbers and new important signals. But before that, let's dig deep into macro. So Ted, I believe that rate cuts are already a fact. So what do you think about the markets, what you see, and what you expect market reaction will be?
Yeah, so I could just be really brief and say, yeah, they're going to cut 25, maybe they'll cut 50 and it's to the moon. But let's dig into some of the data here. Raphael, I assume I can share the screen. Yeah, okay. Awesome. All right. So all right. So let me just launch the show. Breakout or fake out. Depends on your asset. So again, what I typically do, this should be Market Talk 59, touch on the macro regime, just quickly review policy, and then do a little bit of a deep dive. It's kind of revisiting what we talked about back in September of 2024 when the Fed cut, and then revisiting what happens when they cut again into all-time highs, and then take a look at some positions and trades. Unchanged, Goldilocks, growth up, inflation up. That's what the market is pricing. Arguably, we have growth stalling, maybe growth rising, inflation definitely up. So when we take a look at the GDP nowcast, that has ticked up to plus 3.1%. So it does suggest we've got some buoyancy in the market. Keep this little Q1 situation in the back of your mind because we had a huge employment revision, and it may really be reflecting what went on in Q1, less so what is taking place now. But that doesn't mean that data is not driving decisions at the Fed. Since we last met, we had ISM services also showing some growth, printing 52. And as you know, the U.S. is largely a services-based economy. So that's a big driver. We got an inflation print this morning. CPI ticked up to 20 basis points to plus 2.9% year over year, plus 0.4% month over month. It was more like 0.36%, but rounded up to 3.4. I mean to 4%, 0.4%. So we've got inflation ticking higher at the aggregate level or headline level. And then core inflation was unchanged for the month, but elevated at 3.1%. Consumer expectations also ticked up. This came out earlier this week. This is the New York Fed survey of consumers, up from 3.1% to 3.2%. So clearly we've got a little bit of a build in inflation and also in inflation expectations. That said, the five-year forward market expectations actually came down from 2.36% 2 weeks ago to 2.29%. So the market is anticipating that we're probably looking at some lower inflation rate on a go-forward basis. The big number that we got, and this was really the trifecta last week. If you were long bonds, you were super happy when this printed. Although what we had was a payroll report that came out at plus 22,000 against expectations of plus 75,000 for the month of June. And then the big thing was we got this 911,000 revision for the period of April 1st, 2024 through March 31st, 2025. So, basically the Biden economic growth engine appeared to be a little bit of smoke and mirrors here as we got a substantial downtick in revisions. And that really was an impetus for the bond market to really start to accelerate. And then today, we got a big claims number here in the United States, and a lot of people have been rationalizing that Texas this, Texas that. But if you look at the 4-week moving average, 4-week claims average, this has ticked up quite significantly. So something to pay attention to. And the big question is what is the deal with the job market? So we did review this exact slide last time, and I think we had the Fed at Jackson Hole really pivoting from concern about inflation to concern about growth, and more importantly, concern about the labor market. So they pointed out that the labor market's weakening and employment growth collapsed to 35,000. This was in for the August number. And then, of course, we got the 22,000 number and a revision. So we definitely have a slowing in employment growth, some of which has to do with immigration. We have net no immigration at this point in time. And so it may or may not be an issue, but it's certainly one the Fed's paying attention to. And as indicated at Jackson Hole, it may warrant adjusting our policy stance. The administration just wants to run it hot. They've put in all kinds of plans to do so. They're pushing the Fed. They're trying to stack the Fed. They really want to run it hot. So they're trying to stoke growth here. And, you know, as time goes on, you start to think, well, with the employment growth slowing, the economy having fits and starts, you know, maybe they're right to really want to push this thing forward. At any rate, after today's inflation print, last week's employment print, what we have here is the CME's Fed watch tool and conditional meeting probabilities of a rate cut. So market is pretty much baked in 25 basis point cut in September and 2 additional cuts into year end. So 75 basis points between here and year end, and then we'll see. So keep that in the back of your mind, because when we look at some analogs, that 75 basis point and cutting is something to pay attention to. So the question we should all be asking is what happens when the Fed cuts at all-time highs, which clearly we are. So last year, it was actually September 26th on a market talk. I went back and did some historical examples of when the Fed cut near all-time highs, and average SPX returns 1 month, 3 months, 6 months, and 12 months out yielded a 16.2% increase in SPX over a year time. And then when we look at what the best analog was, we concluded at that time that really the best analog was July of 1995, where they cut 75 basis points into a moderating economy. And during that 12-month period of time that followed, the S&P 500 was up 23.7%. So we took that into consideration as we were looking at the market a year ago. And what did we get? So from the September 2024 rate cut, remember that was on September 18th, 2024, Fed cut 50 basis points. What we got was 1 month, 4.4%. 3 months, 4.8%. So really got a big, head of steam in the first month. 6 months, only up 0.6%. And that relates to this drawdown. And then 12 months, I calculated this morning. So it's probably closer to 18.5%. But clearly that's within the realm of what we were looking at in this best analog, which was 23.7%. So we're up 18.2%. We still have better than a week to go to get to that. About a week to go to get to the 1 year point. Maybe we'll get to the 23%. I don't know. But if you just sort of Rumpelstiltskin this and went to sleep for a year, you'd be waking up this morning with an 18.2% return. However, you did endure a 21.2% drawdown from the February high to the April low. And so since that low, S&P 500 is up 36.5%. So pretty big numbers. If you can tolerate drawdowns and you don't pay attention to the market like we do, trying to avoid those drawdowns is super important on a long-term basis. So then it begs the question, what happens when the Fed cuts? They pause, and then they resume cutting at all-time highs. So the best analog I could come up with, and it's actually the only analog, was the 1995 cutting cycle followed by the 1998 cycle. In each of those cycles, the Fed cut 75 basis points. And so the September 1998 rate cut was arguably a little bit about an emergency, because we had the LTCM blow up taking place, but it was a moderating economy, and actually the market, S&P 500, was near an all-time high, but we had some real problems in some of the other some of the other markets were freezing up. So we had 3 months. In 3 months, it was up 18.4%. In 6 months, 24.9%. And then in 12 months, it actually declines from the 6-month basis. So what this suggests is that we really get the biggest bang for the buck into year end with this follow-up cut. Now, I wonder whether, there's some arguments being made about whether they go 50 again in September. I think that would definitely blast us higher into year end, at least based on these historic examples. Then I wanted to ask the question, what happened to other assets last year when the Fed cut? So this is the cut date, was September 18th. And this is the dollar. And this is a 4-month daily chart of the dollar. And you can see that during that period of time, it based until the end of September, and then the dollar just took off and went higher. And this was kind of counterintuitive. Everybody was saying, well, the Fed's cutting, the dollar is going to get blasted. And we have the same kind of talk going on now. Gold's ripping and the dollar is trading near lows. Are we going to get a similar situation? Is the dollar really going to give up the ghost here and trade down to 92? Or are we going to repeat what took place last year? Same question with gold. Gold took off right out of the gate. Actually, on the day of the cut, it was down, but then it rose pretty considerably and peaked here in late October, and then drew down 8.6% before recovering into year end. So a lot of chop in the gold market as we got into the latter part of the year. TLT, interestingly, was near its year-to-date high into the cut and basically sold off 12% into year end. So this is recent history for us, something that we can at least be aware of as we think about what might happen with assets. Now, with hindsight, what was thought was that this was a function of a growth reacceleration, which makes sense. Yields go up on the long end. The dollar appreciates because it has relative strength, and gold kind of chops around. So where are we now, and what are we? What should we be looking at? So this is the weekly dollar chart. I'm basically going over the same things that I've been over in terms of where my trades are. I got a buy signal back in June, late June to early July. I've been long. This thing's done nothing. Trades up to the middle of the weekly Bollinger Band, and basically it sells off and does nothing. And so we're down this week 26 basis points. And it's been chopping along this line, this sort of 97, 98 period, not really doing anything, trying to, chopping around in a range. Really, I have a small position, but my signal's still valid, so I'm still holding it. I got long here, I added here. I actually had my stop hit here, got out took a little bit off, but I still have 200 basis points of a dollar position. As we pointed out last time, I did get long yen back in September, early September. Let's see, it's actually July. I got long the yen on a weekly signal. This is where I was long, August 1st. Has not done much, but is definitely offsetting my UUP position to keep me relatively neutral. And within the last, at the beginning of September, I added a Swiss franc position. I had an inflected bullish, so I got long here. I got 200 basis points, and so I have 200 basis points of FXY and dollar. So I'm slightly dollar negative and skewed favorably towards yen and Swissy. SPX got that great signal back in April to get long. Retraced this last time, long, sold strength. Actually got stopped out in 1st of August. I was able to buy back in on a dip in mid August and have sat on this position. In my mean reversion portfolio, which is a separate portfolio from the one I'm reporting here, I've been selling SPY because I got super long in March, April, and have been selling all the way as we went higher. This is Fez, which is the Euro Stock 50, got long, added to my position, got stopped out, and the thing turns against me. So this has been a tough position for me recently, although it worked really well at the first of the year as I try to get back in. It head fakes, and I ended up getting out 3-4 strikes here, and I was out. And now, of course, it's turned against me, and I can't chase. IWM is another one. Got long back in May, added, started selling at some highs, got stopped out this August 1st date, got stopped out, a bunch of things. I took off half of my total position, but then it went back above my stop level. So I held on, and I've been selling into relative strength. I've got a reduced position now, but I still am holding IWM, which, as we talked about last time, is really outperforming the Qs by a pretty significant margin. EEM I added for review this week. EEM was another one that got long, and I added in this time frame, built up a pretty sizable position, added more here in May, added more here in June, and then my strategy is to sell weakness, sell strength, and trade around a position. So again, sold here into this high in June 23rd, got stopped here. So I got one strike against my 4-stop strike rule. It bounced here and went higher. So I sold some here, bought a little bit more here, and yesterday I took some off. I still have a decent sized 500 basis point position in EEM. And that's worked really well. Of course, we continue to rip higher today on a weaker dollar and general liquidity. And China, actually, the SSCC was up pretty substantially along with FXI today. Crude, can't trade it. Don't even know why I talk about it. But I have been long via PDBC, which is an aggregate commodity fund, still long. It's chopping around. I'm not doing much there, 300 basis points, expecting that we'll get some sort of a move here in commodities at some point in time, if in fact we do have a growth moving forward. We talked about this one last time as well. DBA, I got the signal back in early August. Bought the position, it went straight up. I sold into strength. And then on the 4th, I got this nice pullback. I added to my position. And then on the 9th, which was, let's see, the 9th. Yeah, the 9th, my stop was hit. So I'm oftentimes adding at a place where I'm very close to my stop. So if I do get a stop, I don't have much of a loss in it. And so I did get a stop. I took 1/4 of my position off, and then of course it tipped higher. And so we continue to hold that position, DBA, which is aggregate agricultural commodities. Gold. What do we say about gold? Just continues. Here's what we should say about gold. These were the 3 times that we met. This was on the 22nd of July. Then we met on August 11th, and then we met last week on the 29th. We talked 2 weeks ago. We talked about gold continues to just sort of bounce against this thing. Raphael was super bullish, and yeah, lo and behold, the very next day the thing broke out to a new high, and kept on trucking. This is a daily chart. It kind of shows my activity on this. I have been long gold, GLD in my dynamic positioning portfolio, but I've also been long, very long in my mean reversion account, and had an opportunity to sell IAU on the 2nd, and also sell again on the 8th at some decent highs. We're certainly due for a break here in terms of this momentum. So we'll see what happens from here. Certainly remains very bullish. TLT. This is a weekly chart of TLT. I've shared this. I've been long this thing since May. Very small position. It never went against me. Didn't really do much. So we've been chopping around. We added to the position back here on August 1st because this flipped bullish on me, and I'm still holding a position. Have done nothing with it. I would like to add. I think the market is anticipating additional slowdown. This may be a real breakout. It could be a fake out, but this is really kind of an impressive move in TLT. Would like to see this come back and give me an opportunity to add to the position, at least for now. HYG we reviewed. Since we last met, I was able to buy a little bit more on the 2nd, and the thing ripped along with other bonds, and I sold some on the 5th. Still have a large position in HYG. It grinds higher. I mean, this is junk or high yield, and it grinds at the same, I mean, at a lower rate than a 10-year bond. So it's definitely, the spreads are tight. Junk continues to work. It yields about 6%. IEF is another one. We've been long this quite a long time now. It's finally starting to work. I had an opportunity to sell some here on the 29th, and then sold some more here on September 8th. And 10-year bond IEF continues to move higher. What's not working for me is my steepener. So the steepener had been working really well. So the steepener works well when, for whatever reason, short rates go down and long rates go up, where the spread between the two widens. And what we've seen over the last week or so is that we've had a flattening of the curve, and this has not worked. I did have an opportunity to buy some here on a pullback. Let's see, this is 1966. My stop is at 1958. So I may try to fill my position. This is probably one of my larger positions, so it's not working for me at the moment, but it could after the Fed cuts rates next week. So we'll see. Bitcoin, this is FBTC. I'm pretty much out of Bitcoin, so I got stopped out. I've been thinking this thing's going to break down, and it doesn't. So don't listen to me when it comes to Bitcoin. That and oil. I don't want to skip over that. All right, so this is my trade of the week, and this is XLU, which in my book was still bullish trend. We got this. It's been kind of like just selling off, but we're still above its 3-month price level. So it's moderately bullish. I saw this reversal take place, and so I opened up. This is my trade of the week. I opened up an XLU 1017 83 by 86 call spread for $1.14. I sold half that position yesterday on this nice pop, and then today it looked like it might be failing. It kind of popped up and then started to fail midday. I got cold feet and sold the balance of it. But that position yielded about a 40% return. Not a large amount of capital, but it was a cool trade. Something where you saw that reversal down at the at a pretty oversold level on the daily chart, and was able to add to the position and get a good base hit. So that is my worldview for the moment.
Thank you, Ted. Great insights. And yeah, IWM trade is also totally agree and enjoy looking at spreads between IWM and other indices. So, Raphael, I know that you are tight on time. So, are you as bullish as 2 weeks ago, or even more bullish?
I'm actually more bullish now that I've seen Ted's presentation. I mean, how can you be bearish after listening to such potential returns? So let's go to the charts and let's see. Okay, give me a sec to organize. Okay, we're good. So yeah. Let's go here. Okay, so if you remember 2 weeks ago on the show, so I saw ghost, I flipped out, I chased actually ES on the retest of the monthly target, and unfortunately got stopped 2 days later. Went back in on the retest of the low of the range. I did some more when the new monthly pivot was taken out on the 5th, and I'm starting to sell some today. So I sold some at 6,588, one side of the position. I'm looking for the next monthly target to take some more, around 66.60 to take some more. The way I see it is I'm bullish, I'm buying any dip. The is actually insane. You can see long-term range, normal range, both top of the range, bottom of the range. The slope is insane. It's going higher. You can see also here in black trade and in green trend also the slope is going higher. I mean, as far as I can remember, this is really bullish. So I saw some bears posting some crazy things last week about this is the last time we are seeing 6,500 in a long time, and now we are almost at 6,600 on ES. So I think this thing is gonna continue. My only, I'd say the only thing I don't know is for how long. And I'm gonna talk about this when we reach the VIX. But for now, still bullish. I think we're gonna go to 6,600. We're gonna go most probably above. But then the question will be, okay, what happens next? And again, I'm gonna talk about this when we reach VIX. But yeah, bullish, volatility is great, matrix is pointing higher, range is pointing higher, trade and trend pointing higher. Nothing is bearish. Another clue also that you had was if you monitor the RTY, RTY actually was playing around with the monthly pivot. Anytime it went below, it was bought back up, no close below this pivot, confirming again the fact that market overall in equity terms are quite bullish. So today, finally, we got the break on this candle, but it's not a surprise if you are monitoring the fact that the monthly pivot held. So again, for me, it's another confirmation that the market is quite bullish. Another thing that I was watching 2 weeks ago was the DAX. I was hoping that it would hold trend and that I would be able to take a long. Unfortunately, it broke. And you can see here the volatility for those using my volatility script. Volatility went above trade and started to make higher highs, higher lows. That's not good. That's something that you see in a bearish asset. So for now, not touchy. I'm still hoping to be able to get in the long DAX trade. But for now, volatility is pointing higher. We are below the monthly pivot, so I'm not interested, but I'm monitoring. I would like to see volatility start making lower highs, lower lows, and I want to see a clean break of the monthly pivot. Now let's go to the dollar. So the dollar is basically the same song as 2 weeks ago. Any attempt to break above MFR trend was a failure. Nothing has changed. Range are actually pointing lower. It's not good. Volatility is pointing higher. Not good. So long dollar, not a good idea from in my opinion. There will be a time to change that opinion, but same song as 2 weeks ago, 1 month ago. I want to see trade cross trend. When trade cross trend, then I will start to look at maybe taking a long dollar trade and a short Euro USD trade that I'm hoping for. Anyway, Euro USD. So I know Vi is long this one, and we mentioned 2 weeks ago that it was a great idea. I'm a little bit surprised by the fact that it's not actually ripping. I was expecting Euro USD to go much higher. Maybe that's something coming this month. But yes, that was a little bit of a surprise for me. In any case, trade of volatility is pointing down. Volatility looks great, and we are still quite far away from the minimum daily trade value that would indicate potentiality of a short for Euro USD. So mark this one if you are using my script, 1.1. When the black line here, trade of volatility reaches there, you can look for clues maybe to take a short then. But for now, it's a longer trade. But yeah, when we get there, watch where we are in terms of monthly targets. Maybe you will get a sell in my buy and sell script. But yeah, for now, it's a long. Now let's go to VIX. So I'm very bullish equities. But something is about to happen regarding VIX. The only problem is the calendar, and that's the big question. So you know already the 3 cycles for VIX, for VIX volatility, sorry. You have insane gap between trade and trend, and what happens is you have a catch-up. So the catch-up means volatility is going from a very high place. Volatility of VIX is going from a very high place. Trade of volatility is going from a very high place to a very low place. And this is the time when you are actually buying blindly. Sorry. It's when volatility is rising, volatility of VIX is rising, trade of volatility is rising. This is when you buy blindly. And then you enter second phase. This is when we start to have a catch back down. So trade of volatility is starting to go down. Volatility of VIX is starting to go down. This is when you are more selective. So this is the second phase. And the last phase is when you have trade of volatility and trend of volatility that are crossing. So you know this kind of setup because this is the kind of setup we use to long any other asset, be it stock, be it I don't know, like ES or oil, it doesn't matter. The principle remain for VIX. So when those two will cross, we will be entering the third phase. The third phase will be at some point VIX will rip. So it could be a rip to only 20, it could be a rip to 60, it doesn't matter. Once those two crosses, you can start the clock and the rip will happen. Currently, my thinking is still that VIX will break the 14 floor. So I'm expecting to see actually VIX entering the 13 area to continue to have the blow-off top that I'm expecting in ES. But if we get there, I'm gonna be on the lookout to first reduce to the minimum my exposure to long equities and possibly to buy some puts to play the up move that I'm expecting in VIX. So one of the most important things that you should be watching right now is when those two guys cross and what's the behavior of VIX when this happens. So we will see in 2 weeks where we are, but I'm expecting this cross to happen soon. And my actions will probably be to decrease to the minimum my exposure to equities and maybe to bet on some downside in equities. But for now, this is next play, it's coming. But for now, still blow off top. That's my expectation. Now let's go to CL. And yes, something else. When we get this pop on VIX, I think this will be a very, very savory dip to buy, because you have to consider everything that Ted told us, what happens after the cut. So when we start to see the pattern materializing and we start to see the sell-off, expect deeper sell-off than what that we had recently with this kind of pop. It's going to be, I think, a larger one, and it's going to be a savory dip to buy for the rip that is supposed to happen when they cut. Okay, now let's go to oil. So oil, not touchy. I had I had a miss on the buy last month. The problem is now it's a new month. We have new levels, and the levels are quite lower. So you have still this asset in a bearish trend, be it for my signal or be it for MFR. It doesn't look appetizing, so no touchy. Maybe if we get to the 50s area for CL, maybe I will take another look. But for now, volatility doesn't look good. The targets provided by Vi are much lower than where they used to be. So I'm not touching this one. Now gold. So gold, 2 weeks ago, I mean the path was quite simple. We had volatility making lower high, lower lows. We had trade of volatility making lower high, lower lows. So clearly we were out of the chop that we were experiencing for the past month. And what happened was confirmation of MFR trend and the rip. Now the thing is, we already reached the second target to the upside on gold. So let's go to JC because I have some other stuff marked. And what usually happens when we get there, especially considering that I have my sell signal starting to trigger, is you get some kind of sell-off. The sell-off usually goes to my volatility trend, just to allow the people who missed this rip to get in. So my expectation for gold would be we get some kind of short-term sell-off, quite quick, maybe 3-4 days, and buy this dip. Buy this dip because this thing is gonna rip again. And another confirmation for that is the fact that trade of volatility for gold is still quite far away from all the minimum levels that trade has to reach before we get some meaningful sell-off. So until then, any dip is a buy, and my expectation would be we get some kind of short-term sell-off here in this area. So 3,550. So this is the levels on futures, but if you look at gold, yeah, so in the 3,500 area, I would not be surprised to see this kind of move. And this is a dip to buy. Okay, so mark those, maybe put some alerts, and get ready for the next week backup. Now Bitcoin. So 2 weeks ago, I think it was Vi who said that maybe this area was a good buy, potentially a short-term bottom or the bottom. Why did he say that at the time? He said that because we had a cap to the downside. So low of the range, low of the long-term range are equal. Another reason was that you had just below, you had the first monthly target to the downside. And we didn't buy this one. I didn't buy this one also. So maybe it was the bottom. I still don't know. What I'm watching is, the box. I'm watching for volatility to get inside the box. So the idea again, you need to have volatility at the floor so that the asset can rip. So sure, I could have bought here, I didn't, but I don't care. I want the volatility here back at the floor. When this thing happens, I think this thing is gonna rip. So I'm watching volatility of it to see what happens. One big change that happened since the last show is actually all the yields, so 2-year, 10-year, and 30 years, the one that I'm watching, broke below the box. So those three were inside some kind of range, some kind of box since April. Yeah. Finally, they are out. Another thing that confirms maybe a change is also the fact that so SHY, IEF, TLT, EDV, zeros, all of them are now bullish trend. Also, if you look at the volatility, trade pointing down, the retest of volatility here, perfect. You can see the same kind of pattern in all of them. So if you saw that, it was a great long to take. So it was to give some food for thought for Ted. Now some other positions I've been playing around. So I had a long Apple. Unfortunately, I got stopped on this one. I managed to take some off at 240, but got stopped here on the cross of trade of volatility. I'm not looking to get back in. It was just a play for fun. Another one where I got stopped out was Microsoft. So Microsoft, I took this trade here. The reason being was trifecta of a lot of factor. Number one, we held MFR trend. Number two, it was the first monthly target to the downside. Here, you had also a cap. Unfortunately, new month opens and we break the entry. So I got stopped on this one. I don't know. Let's see what happens. But yeah, volatility is rising. It doesn't look good. Another position that I took these past 2 weeks is a long Tesla. So this one is just beautiful to watch. Volatility down, trade of volatility down, retest of MFR trend. You had the hold of the monthly pivot here, and this one is ripping. So I'm looking actually to take some off at the first. It's another time frame, but I have a weekly pivot at 370. I'm looking at 370 to take some off. I think this one is gonna rip, quite representative of the kind of behavior you get in a blow-off top. So I don't know if you are watching the volatility profile, but this one looks amazing. And I want to conclude by addressing one question asked by a user. So I'm gonna let Vi go deeper into it, but he was asking, okay, I see some big tech stocks actually at the monthly levels. And I want to talk about one particular one, which is Google. So Google, amazing volatility. You can see here, a perfect long. And this is the kind of behavior you want to see in your long. Now the question is, what do you do? Because we already reached the second target to the upside. You have a cap. And I'm starting to get some mega sell. So for this one in particular, if you are long Google, I would take some off. I would be more aggressive on taking profit than maybe in some other names, some of them that actually don't look that good. So I just wanted to talk about this one in particular.
Raphael, I don't know if you have a couple minutes because there are new comments on YouTube that are asking about DAX and CAG.
Okay. Give me a sec. I'm gonna have a look.
I can answer them if you are in a hurry.
Could you please interpret the DAX and CAC in the context? Yeah, you can take this one now.
I will.
I have finished.
Yeah. Okay. So thanks, Raphael. I know that you have to go, so enjoy the rest of your evening. Ted, also there is a question on that XLU spread. What duration did you take the option trade? So can you add some more information? Viewer is asking.
Yeah, it was October 17th expiration. So relatively short term, I think maybe 35 days. It was 83 by 86 call spread, and the underlying was trading at 83.14 at the time of the trade. So I got a nice 2-day rip from 114 to 165, 166.
Thank you. Okay, so I will share my screen. My presentation will be more related about the overall capital flows and macro conditions in the markets because this is a rollover week, and rollover week is not the time to initiate any new positions, at least for me, in equities, ETFs, or futures. So yeah, I will share my screen, and after that I will answer the remaining questions, and we'll give more examples on how to interpret the targets because I see there are questions about that. Okay, so first let's talk about the usual suspect, which is correlations. And actually today there are a lot of interesting signs and signals in the overall correlation and dispersion analysis. So first I want to start with average correlation to SPY. Again, as always, a reminder, this script is available for free for everyone. All it is just average sector correlation to S&P 500, and we will start from a short term, which is a 10-day, and we can see that this overall rib higher is again not is again caused only by a couple of sectors, couple of bigger names, you may say, but we are not in the environment where everything is going to the same direction together. So yeah, 0.4 correlation is relatively low. At these levels, we can actually expect some reversal in the correlations, and of course we first need to see if that happens, and we need to see what's going on in multiple time frames, because if you zoom out, you can see that even though negative correlation is very rare, and in the longer time frames it's basically something that basically never happens, but in the short term it actually could happen. But basically we are in the really low territory, which can be, if we only use this as a signal to talk about, it can be interpreted in two ways. One thing is that, of course, trade is not crowded. If the leading sectors continues to lead, and others may start catching up, and it will give fuel to this rally. Or another one, if we see these correlations reverting, usually it may signal a potential correction that would usually start if we get to a higher values. But overall, from correlation perspective, I'm really disagreeing with people who are saying that the overall market is in a territory where it may explode. I would say that some stocks or even some subsectors are in that area, but this thing can continue for way longer, and we will go to 21 days just to show you what's going on there, and the same situation is here. Correlation is below 0.5 and going lower, and yeah, you can see, of course, that it can go to way lower than that, but it's not something that happens very often. So keep that in mind. I'm always looking at average correlation to SPY to understand what fuels this move. Is this move a macro move or a rotational move? So it means if everything is moving together or if certain sectors are leading and so on. So definitely we're in the low correlation environment, and it will not last forever, but our job is to not fade what's going on, but to look for opportunities to scale out and only react when we need to react. Now, when it comes to stock bond correlation, it's another topic I want to talk about, and of course we all see what's happening, and it's not hard to come up with narratives or reasons why it's happening. But yeah, of course, stock bond correlation. So first we will talk about 21 days SPY TLT correlation, which is at a 0.5, which is positive, and actually quite strongly positive, knowing that it's a stock bond correlation. So yeah, so now we are in a period again where everything starts to move together. Of course, we see yields going down, but for now, this is good for both bonds and equities because, well, they are both going up. But monitor all these changes in correlations, and keep in mind if correlations remain strong and positive when you see a correction in stocks or some news that will cause bonds to go down, you can expect it to have an effect on equity markets or vice versa. So, and the same situation, that's why today I really want to spend more time talking about that, is that the same situation is in the short term and even higher. So SPY TLT correlation is at 0.55. QQQ TLT correlation is even higher at 0.73, which is a number you would very rarely be able to see. So yeah, and we can take a look at a chart, which of course gives us context. So this is a TLT chart, and the correlation is measured against SPY. So you will see the exact same. So for example, these levels at 0.55, 0.56 is not something you see very often, or even if you see the spikes quite often, it almost never lasts for really long. And of course, we are already seeing that correlations a couple of days ago were a lot higher than that, and now we are going down. So yeah, I first of all, I expect these correlations to go lower, actually way lower, but my main concern and main question will be, of course, which asset will lead that move. So because if I expect correlations to become lower, but at the same time, maybe I still expect bonds to continuing going up. That may cause some trouble for stocks. But regarding stocks, we need to wait for September cycle to end. We will get new expiration prices, and we will get new important levels for us to watch. So this is regarding that. And now spreads. Today I really wanted to cover the spreads and what is going on. So I will start with a SPY TLT spread, which is a daily chart. We have targets that were breached, and now the market is correcting a little bit. But basically, how you need to view these spreads is I think of them as a risk barometer or risk spread because if this chart is going up, so it means SPY is outperforming bonds. We can say that it's a strong risk-on environment, and of course we are in a strong risk-on environment, and it will not change until we see real breaks in all stock bond spreads. And I tweeted a couple of days ago that maybe SPY TLT is about to break, but now I see that other spreads, so especially IWM TLT, is nowhere near breaking, and we had a couple of calm days in this relationship. So it's something very important for you to watch. You can create decent spread charts on tradingview.com also. High and low will not be correct, but open and close will be correct. So you can definitely use that. But it's a very important chart and very important thing to look at, because if you see this spread and then IWM TLT spread starting going down, making new lows, and that's usually a sign that whatever correction in the stock market you may think, it can last for longer, and the move down can be bigger. Usually when you see, for example, stocks correcting for a couple of days, but stock bond spread is calm or even going up, usually you can call it a buy the dip moment. So it's very important. And what I meant is that if we are now looking at IWM TLT, this one is looking totally different, no new lows, and today we had, of course, a strong move, not only here but in the IWM SPY. My main question is, are we in the new cycle where small caps will outperform? I had this view for quite a while, but this view is not some sort of long-term view for years to come, because we will see if it breaks way higher, then maybe. But when you're looking at longer term charts, longer term charts, well, I don't think there's a lot to say about it, because it's just we can go to weekly, and yeah, this chart is just going down, 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 and now in the short term we definitely see signs that IWM is outperforming. Now I want to believe that if we get rate cuts, and if overall market reaction to these rate cuts will be quite positive, that this trend will continue, and actually small caps will be a great trade for the next quarter, or even multiple quarters to come. But one level at a time, one step at a time. But these spreads are very important. And now what we can see, I will come back to where I started, is that risk-on situation is not ending. At least for now, it doesn't look like it's ending. But now we will get increased volatility to both sides just because of rollover. So if you want to initiate any new trades in major equities or ETFs, I would wait for at least a week, and then we will get new major levels, major targets, and we will be able to better understand what can be expected for the Q4 of 2025. So yeah, this is what's going on, and no doom and gloom. At least I don't see immediate crashes. I see potentially increasing volatility just because of a rollover. Yeah, so couple updates on the positions, and then I will go to questions. But yeah, and before that, I will cover assets like gold. But yeah, so I'm long 6E, still long 6E, which is Euro futures. I need to take care of the rollover gap currently, but my views are not changing, and the last expiration pivot of 1611 was not reached, so I'm still in this position. So what happened? During that show, I said that when we came back above 1611, I opened long. I expected this move to be way stronger, but I'm still in a position because later this level was never breached. More recent lows, all of the lows are higher than 1611, so I'm still in a position. But now I need to take care of the rollover, so it's about time for me to close September and place a limit to enter into a December if I get a better price. We will see. If not, then I will use new generated targets and levels to reinitiate that position. But yeah, this is a view. Dollar, still, I don't see any signs that dollar overall has bottomed. Of course, be careful because we know that the decision is coming, but and Ted showed really great data on that, so keep that in mind. But at least for now, I remain bearish US dollar. I remain bullish gold. Gold has a couple of important levels now for us to talk about. One is 3604. 3604 level is one of my swing counts that I think of as a very important level, and market actually may retest that. But before that, we have this monthly target, which will, if we come back, will act as a sort of a support. And when I will start answering questions, I will give you more examples on how to interpret that and how to use it. But gold overall, yeah, gold basically reached the second monthly target. We have, of course, situation where in trading plan video I explained how to come up with a third target if needed. So watch that video. It explains everything, how to add, how to scale out, how to use pivots, and of course how to combine everything with MFR ranges. But overall, the quarterly picture, I mean, gold has plenty of upside, and I would even say that I expected whatever correction we may have to 3604 or 3620. But after that, I expect gold to be making new highs, and this overall move is a very strong statement, and that statement is not over, I believe, especially monitoring everything that's going on. And of course, on Twitter, I saw some comparisons about how big of a breakout it is. Some people even called it the biggest breakout in history, but luckily, gold futures have a very long history, and when you analyze something with a long history, you can't analyze it on a price scale. At least it's not how you would do that when you analyze. But if on TradingView we switch scale to logarithmic, and we will see this move where gold literally went from $100 to more than $800. So if we use it on a logarithmic scale and we just do some simple measurement for us just some simple. And trading view is has this setting, which is very important setting. If you go to Fibonacci's, whatever, you can just make sure that fib levels based on log scale is enabled, and then you will see that equal measured swing from this major move would take gold to, well, I'm not calling these prices, but I just wanted to show that in the history of gold, we had moves that are way bigger than that. But of course, you need to know which scale to use to be able to see this. So yeah, these are the levels. You can use monthly and quarterly targets for the prices above, but to the downside, yeah, 3604, 3580. Yeah, these two prices would be where I would be willing to really buy the dip in gold if we get a dip, of course. And if not, a break of the second target will be where you can add the position. Yeah, one thing that I agree with Ted is that oil is really tricky currently, and if we are looking at the targets, I would be interested to see how oil reacts. One of the following: either if it reclaims monthly pivot or at the first monthly target. So these will be areas, because on a quarterly basis, and we still have like 3 weeks left for that, downside is way lower. Pivot is about the same, but yeah. So now if I would try to get some long exposure in oil, I would wait and see if the price gets to these levels, and then maybe initiate a small position with a tight risk. But other than that, I only want to talk about Bitcoin, which is actually surprisingly not falling. So yeah, as Raphael said before, so let's go to ranges. This cap and the price being close to this level was a great buying opportunity, but during this month, I actually wanted to see and still want to see Bitcoin closer to 100,000 for me to be able, for me to be interested in buying, because I was scaling out for months, and you can see it in Raphael's and mine tweets before. But when the price reached close to these levels, I totally got rid of my remainder of my position. Now I don't have any Bitcoin, and I missed this buy. Well, I missed it. I said on Market Talk that it can be a decent level to buy, but I wanted the price to actually reach the target, and it reversed a couple hundred points higher. So yeah, now I'm not in the position, and now we can see that the range is basically, we are at the top of a regular term range, and for this month we have first upside target, which is quite close. So I would be rather willing to buy on a break of the first target on the way to the second one, and of course, we also have this very important matchup, which is that the second monthly target is basically the same as our quarterly level. So this gives me even more conviction, but I will not execute in the middle of nowhere. I would rather buy on a breakout of the second target, sorry, of the first monthly target than now, because especially seeing the ranges, and ranges suggest that we may have a day or two of a correction, which will happen or not, we will see. But the plan is to look for pivots, so monthly pivot and quarterly pivot, or if these get broken to the downside target, which is basically 100,000, and 100,000 is where I would really be interested in. But if I see strong momentum, like I said, we are momentum traders, not people who are holding things that are not moving. So if I really see a strong move, I will be even interested in buying higher than now, because that's what works. At least in my process, you want to buy things that are going up, not buy things that are going down, usually. To recap on the overall view, keep in mind that rollover week is very erratic. We will get capital moving from September to December, so I will not initiate any new positions in stocks or ETFs or options at least for 1 week, and then we will get new expiration pivots and new levels. And also I will make a mid-month trading plan video with all these when September contracts expire, because these new numbers will be the most important numbers for the December expiration cycle. So I'm looking forward to that. It will happen most likely next weekend. So more than 1 week from now when contracts expire. But yeah, gold bullish. I'm still holding euro. I need to adjust that, but my view have not changed. And stocks overall, definitely not a fade. Scale some down on the targets if and hopefully you are holding, so that would be a place to scale, but definitely not a place to fade, especially during a rollover. Yeah, okay, so now I will go to questions because we have some. Okay, please comment on what your opinion is of mega cap tech and XLK being at monthly targets. And I'm really happy to see this question because when I saw, I prepared a chart actually. So first of all, we will go to a custom symbol formula, which you can do it on TradingView. It doesn't matter, it's just average max 7, which is you add all 7 stocks and divide by 7. That's all it is. Basically we are getting back to the all-time highs. We are above the monthly target, and we may be even if we make a new highs. This average chart will target the second target. So yeah, definitely. Overall, Max 7 is strong, and mega cap tech stocks are really strong. Not all of them. Now we see that Microsoft is struggling. Raphael was topped out. I still have that vertical spread, but just because it's the vertical spread. So my stop was basically decided when I initiated it, and I still have some time left. So I will hold my short strike is 520 on Microsoft. I don't know if we reach near, but that's why I like spreads. It gives me some time to be right. So, but yeah, Microsoft is struggling. But overall, as you can see, the average Max 7 stock is going up, and is just one good day, let's say like this, one good day away from making new all-time highs. And now the overall question was being at monthly targets. So we will go now to TradingView. It will make things way easier, but we can choose any stocks, and of course we had this decent rally in NVIDIA. So when I see also the upcoming question from Fitzroy, and the part of that question will be when the second target is in place. So of course is in place. So of course second target is in play when the first one, when the price closes above the first one, because these are momentum targets, and how you view this if you are long, you scale some close to the target here, and then you hold. If the price breaks up, or you hold to the second target, or you are even if you are more aggressive on a position, you actually add on a break on of the first target. You are not increasing your risk because you will get out if it comes back below, but it depends on the aggressiveness. So you either write the remainder to the second target, or you even add. But second target is in play when the first one is broken. And in the trading plan video, I even explained how to calculate further targets if needed. I highly recommend to rewatch those videos if you have any questions how to use ranges, targets, and so on. But my opinion on mega cap XLK and all this thing being a target is this. So your job, at least in this process, is to be scaling out of your position. So, for example, if you are asking because you are long XLK, you had multiple reasons to scale out of some of a position you may have, because of course ranges we are at the top of the regular term range. We are at the second target. Even though it may look like second target is the top because now price is failing, but I'm scaling out of not all position. If I have a good position, usually it doesn't make any sense to get rid of that. Of course, unless your size is so small that you just can't. But nowadays, especially with all this fintech and commission-free and fractional stuff and so on, usually it's not the case. But my view is this. So let's say you are long, and wherever you are long, we had a cap here, and then price closed above the monthly pivot. So let's say you are long. Here, somewhere here, no need to wait for a exact price, but somewhere close, you sell maybe fourth of a position or something. You sell it, and you keep your stop is at a break even for the remainder. You don't have any risk unless a big gap happens, but you don't have any risk on that position. So you hold the run. Now with historical news and so on, you wake up one day and you see this. What you do? Okay, sell another quarter or a third of that position. Keep that remainder. Now your stop is here and is somewhere here. Or if you really believe in this, you can easily keep it at your entry point because, okay, you already took some money from that trade. And if this move continues, you will be very happy that you did. Now about adding, I talk a lot about adding to positions on the trading plan videos. I will not talk about that here because it's actually something you need to be careful about. But basically what that does is you increase your size without increasing your risk if you do it properly, like I showed on trading plan videos, and I will continue to talk about that a lot in these videos. But my overall opinion is everything is going up. Of course, yeah, today Oracle is going down, no surprise. Is it the top? I don't know. And the good news is that I don't need to know. What we need to do is execute where it makes sense to execute when all signals align, and to scale out also where it makes sense to scale out, and always watch the bigger picture. Always watch the bigger picture because bigger picture for tech is, well, a long higher. So yeah, quarterly pivot is here, monthly pivot is here. So of course, all these examples depend on your situation because of course I don't know if you are long, where you bought it, what's your price, what's your size, what's your aggressiveness, and so on. But this is how I interpret that. Okay, I hope it answers your question. So tech being a monthly target just means you need to sell some. And if it continues to go up, you will be very happy that you still have a runner. Could you please interpret the DAX and CAC 40 in the context of the MFR ranges and the MFR targets? I still don't fully understand at what point the next target comes into play. Yeah, so second part I already answered. From level to level, from target to target. Yeah, so but I really recommend to rewatch those trading plan videos. More to come, but in these videos, that's where my focus is, to not give you real numbers, because numbers you can see them on TradingView or in Excel spreadsheets or something, but to explain the process, to explain how to interpret things and everything. But yeah, I can even go to maybe DAX and yeah, but as explained in trading plan, how I interpret the ranges. So of course, the strongest signal is the cap. We already know that, but even if there is no cap, okay. So let's say you want to buy the DAX, and it doesn't matter that I'm looking at futures. I always do index, ETF, same thing. Doesn't matter. Price approaches downside target. You start showing interest in maybe buying this, or let's say you look at the ranges. Okay, so in this case, longer term range is basically still quite far away. For example, here situation is starting to look better, but still nowhere near the cap. Sometimes when it comes to cap, I view it, with a couple of, oh, it's not a continuous contract, sorry, so these numbers doesn't make any sense. Really sorry about that. Okay, so how I view the cap. Yeah, now these numbers make total sense. So we have this situation. Price is approaching the target. You are interested in buying it. Longer term ranges are still far away. Longer term ranges are still far away, even though, yeah, regular term ranges kind of support your decision. But for example, here I would not be interested. I would not be interested until I see some reaction. And the reaction may be the retest of this target, for example, or the change in the ranges. But the main combination, that's why when we introduced targets, levels, pivots, I said it's not a replacement for a range. Process will always be to start with ranges and trends and correlation to understand what's moving where and what relationships are. But I know that people, a lot of users will just start looking where the target is, and that's why I need to explain. Okay, so you see that depending on your time frame, your regular term range, maybe you are not looking at the long term. I suggest you do, it's very important, but maybe you are not. You see, oh, we are at the bottom of regular term range. Okay, where the target is? Oh, we are basically at the downside target. You could buy, but then hopefully you scale some out or close the position. Hopefully it was a short-term position, because for longer-term positions you need confirmation from longer-term range. Longer-term range is something where you literally know that with months and months and months of data and analysis, this is the potential low end, and yeah, regular term range will show you short-term levels. But this is how you combine them. It's not about any particular number. It's not about some monthly target or quarterly target or the range or the Hurst. It's the combination of everything. So of course, if you see that price is falling, it's at the target you are maybe interested in, but low end of the range is far away. It's not an A+ setup from risk management perspective. Of course not. And always you look multi-time frame. What's the situation quarterly? So pivot is basically the same. Nice. So this level becomes even more important. Your bias is above the pivot, as I explained in the first video. Above pivot, your bias is leaning long. It doesn't mean that you're clicking button to buy, but your bias is leaning long. Below the pivot, your bias is leaning to being flat. I know that I should say being short, but I don't think that shorting stocks is something majority of people should do. But yeah, this it's a combination of everything, and you can see that on a quarterly basis. Well, targets are far away. On an annual basis, basically, you need to use the technique I showed in trading plan video. You can come up with a third, but you will notice that you don't need it because usually it matches with something else. But yeah, I hope it answered the question, and this show is already long enough. If you have, as always, if you have any questions about the trading plan, about the process overall, just send us an email and we will be happy to answer and explain. And for now, yeah, next show will be after rollover, which is important, most important week of every quarter for me. So I'm looking forward to it, and I know that we will have a lot to talk about. I see that there are no other questions, and yeah, the show is already long. So I hope it was useful. Manage your risk, and see you in 2 weeks. Thanks, Raphael and Ted already left. So thanks, Raphael and Ted, for your insights. And thanks, everyone, for watching. I hope it was useful. And as always, manage your risk and looking forward to your feedback, questions, and suggestions. Bye.